The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, as we take a look at Wednesday's market action, we'll call it mostly risk off. It was pretty much red across the screen on the day. We have a lot to dissect to take a look at, and here to join us with market analysis on the program, our good friend Mike Zuzolo with Global Commodity Analytics. Mike, always good to catch up with you. It feels like Wednesday we maybe had a delayed reaction to Valentine's Day with red pretty much across the screen, commodities, stock market, you name it. It was pretty much a risk off day, as I alluded to.
Yeah, very big hump day today, Jesse. That's no question about it. And really kind of disappointing given the fact that we were up against some really key technical resistance levels that I think if we could have gotten above it, we would have uncovered quite a bit of buy stops. But unfortunately, we've pulled back yet again. And I think this is probably 5 or 6 weeks in a row that the March corn in particular has just not been able to do much above 685. And then all of a sudden we find ourselves back to 670, 675. So more of the same, but just some new information out there.
Well, let's talk about some of that new information. I'll pull up one of the charts on the video feed and, thinking about a higher dollar on the day, Wednesday, a lot of this inflation data and more out this week. So let's start here. Walk us through what you're seeing with some of this outside market pressure, how it's relating to commodities.
Yeah, if you're familiar with this chart, you're seeing the dollar in the blue line against the iShares emerging market ETF that's traded on the New York Stock Exchange, fairly heavy volume. And this is one of the key charts I use and keep track of for clients and subscribers. It's very easy to see ever since the financial crisis that these two tend to move opposite one another. They're diverging with one another, and their prices are kind of a mirror image. And so it's very important now that China's come off their zero COVID policy, and we've got this spy balloon issue now. We've got these two forces that are working against each other, because China said today that they were looking at some type of reprisal or some type of response to what we did to their balloon. They don't know what they're going to do yet. And so that really kind of shakes the foundations of buying into the emerging markets, which we see in that EEM where that question mark is on the far right part of that lower purple line. So we had that big shot up. We went up against a major resistance line drawn off of those highs in that EEM back there in 2021 and 2020. That resistance line held, and I think the big reason why it held was, as you say, the dollar caught a bid. Well, why did that happen? CPI data yesterday, retail sales data today, much stronger, both of them much stronger than the trade was expecting, especially retail sales coming in for January year over year, still 6.4% above last year. Even food and drinking establishments saw about a 7.2% increase in January. So that gives the market the idea that the Fed's going to continue with even more pressure on raising rates. That's going to give us higher Treasury yields, and that's exactly what's happened. The 2-year Treasury yield is back to about 4.62%. The November 15-year high, November of last year, 15-year high in that 2-year yield was around 4.88%. So we're just really knocking on the door again of a 15-year high in that yield for the U.S. Treasury. What does that do? Well, it tells and signals the markets, along with the spy balloon issue, get out of the emerging markets, especially with the controversy, the geopolitical controversy we're facing. And that then therefore creates a kind of a sell-off in those big key currencies. Mexican peso, multi-month low today. Brazilian real, it's back up towards a 6-week low. And then the offshore Chinese currency, up towards a 12-week low, 10 or 12-week low at this point. It just says U.S. product is expensive. and the ag sector can't get a bid underneath it, and that's where we see this liquidation. Not heavy volume today, but and no technical damage done, and we can get to that later, but it's the narrative that we faced really ever since the fourth quarter of 2022. We just can't get out of the Fed China cobweb or spider web at this point.
Well, Mike, I know as well. I'll dive into the wheat market here for a second, pull up another chart, the monthly HRW wheat. It seems like wheat is typically most affected by a higher dollar. And we've talked about that before, but it ended up kind of being a day where wheat was the downside leader. The soy complex came back a little bit. So when it was all said and done, wheat was kind of our leader to the downside on Wednesday.
Yeah, it was, and that's a problem, especially when you've got a lot of precip that's supposed to be falling in the hard red wheat belt, and it's coming in terms of light snow and very light precip. I doubt if we got more than 2/3 of an inch of rain here in northeastern Kansas when we were supposed to get quite a bit more, and I think that's the upper end. And so, and then you go back to what's happening with the grain deal and the initiative, where Russia has essentially said it's dead. Russia's having this massive offensive. I just read today on one of my European sources that they're looking at bringing in some fighter jets now to complement this major March offensive that they're doing right now. And the Ukrainians are really kind of screaming at this point, we need big time help. So that did nothing that we did in the last 2 months as far as supplying the Ukrainians with more and better armaments did anything to deter Vladimir Putin. In fact, it probably revved him up more, and it probably revved up the relationship between the Chinese and the Russians more. So, Jesse, you hit it on the nose. This chart really shows you by that purple wedge formation, we've actually broken out to the upside. We went lower in January, but really came back right essentially unchanged for the month of January. That gave us that breakout this month that allowed us to go above and actually make a new 3-month high in that hard red wheat chart. But again, we're stalling out again because of the tight supply story from the Ukraine and Russia grain initiative and the weather story kind of getting old at this point. So I think this is where we just need some demand to come in and help us. And I mean the weekly export sales, and meaning some bids that come out of tenders to the Middle East, where we come in and actually put out some bids to or offers to sell into the Middle East here if we get some tenders.
Well, now I was looking through some thoughts you had as well in this corn market. I wonder how this is all tying in. We tried to break out early in the week, didn't really do it. This corn market's staying relatively range bound. So we think about, the corn market specifically. Do you have some concerns? Do you think we have a breakout coming? We're going to stay range bound here for some time. What's your thoughts with how corn's acting here, despite all the moves in some of these other markets? Because largely corn didn't do a whole lot on Wednesday.
Yeah, that's an excellent question because corn does have some support underneath it. It looks better from a spread perspective. It looks better from a wheat corn perspective as well. I think the answer to me, Jesse, if we're going to stay in this spider web of Russia, China, and the Federal Reserve like we've been dealing with for the past roughly 6 months, I think the cash corn will remain very strong, very well underpinned. The basis will pick up a lot of the negativity in futures, but I'm nervous that the futures will fall with the wheat market if the wheat decides to break down, kind of like we've seen before. I do think that the ag attaché coming out this week for Argentina, cutting production another 2 million tons, cutting exports down to 31 million. And if you remember, you and I talked a few weeks ago, and I was at 25 to 30 million tons for Argentina exports. So we're getting closer to my forecast. And instead of major exporting countries having about 1.5 million more tons of corn than they did last year, I think they're going to be essentially down 1.5 to 2 million tons. And I think that gives us more play in the market as far as getting more exports of corn. Corn exports into the world market, to me, look better than beans or wheat at this stage because of the major competitors out there. India's not going to have a really big corn crop. They're going to have a really big wheat crop. Now, that could take away from the corn demand, but I don't think it substitutes it that much.
Soybeans too. I noticed bean oil came back a little bit. I think that helped out the soy complex as a whole a little bit by the close on Wednesday. I know the NOPA crush numbers were below expectations. Seemed like that was the main catalyst there late in the session for soybeans as well. Caught up in all this risk-off dollar influence trade.
Yeah, it supported the WASDE report too. We had that 10 million bushel cut. We all wondered about that, whether that was accurate or not. And so it does support the USDA cut from the report. So we had to go back and revisit that, I think. But I think you're right. The overall mindset is we still got bad weather in Argentina. The meal is still up there around $500 a ton. It isn't giving any technical sell signals yet, in my opinion. Although the bean spread is starting to weaken, that July Nove bean spread doesn't look nearly as good as it did a week or 10 days ago. And so you can kind of feel the sensitivity of the Brazilian harvest hanging over the market now, whereas before they were kind of forgetting about that, thinking about only the Argentine drought. So I would say beans are really on kind of life support right now when it comes to the technicals, and I would even say the sentiment in the market is kind of on life support as well. So this is where it goes back to we need a good, strong weekly export sales number on Thursday morning that kind of maybe should help jostle this trade back into the mindset. Well, we're not losing a lot of demand, but Brazil is shipping out several 100% more beans than they have month over month at this point, from what I'm reading, and that's with the harvest somewhat delayed at this point.
When we are talking today with Mike Zuzolo, Global Commodity Analytics, getting his thoughts on the market trade analysis midweek. Mike, let's talk a little bit about energy. You sent me over a couple of charts there. And I know this energy market, we talked about crude oil being kind of a canary in the coal mine here. I'll pull up a crude price chart here. As you take a look at this energy sector right now, mid-February, seeing some of the moves here, watching diesel prices, gas prices, et cetera, walk us through what you're seeing as you look at some of these charts.
It's a very odd situation we're in right now, Jesse, and this is one of the nice things about your program to be able to talk about this, because if we've got such strong CPI and such strong retail sales, I know we're rebuilding stocks into the SPR, but we had a massive jump in crude oil stocks, and that's the black line on this chart. We're back up to 471 million barrels. The green line down at the bottom is the percent more of stocks that we have versus the end of 2021. That's kind of my bellwether when we had very low crude oil stocks and the crude oil price, which is in purple, was just getting ready to rally and get to that $120+ range. And so what we're at is 12% more than at the end of 2021. And you notice this big jump in the black line. We've really built stocks sharply ever since the end of 2022. And so it really makes you wonder, well, how can we be in terms of total product demand of distillates, meaning unleaded and diesel, how can we be down 10% on a 4-week running average, which EIA gave us today? How can we have the biggest crude oil stock since June of 2021 when we've got these CPI and retail sales and some of these other economic numbers that are just on fire? And I think this is a real anomaly in this market. It's something we really have to watch. And what it could be is that the economic data is not as correct as it used to be because there's less economists and analysts that are actually feeding some of these surveys. I've read that, and I think that's something that really has to be watched. So if we've got a big buildup in supplies and energy right now and prices are going down, this may be a really good time to get loaded up in terms of your needs for fuel and take advantage of this.
Well, and you mentioned those needs for fuel. I mean, Mike, we're a couple weeks away from spring field work. In some cases, southern areas, we might be starting that up here, by the end of the month. So I think about, diesel prices and what the trend line looks like. What are you seeing there when it comes to the diesel side of the equation?
Yeah, the thing I like about this is the PAD 2 Midwest diesel price, cash price. So it's really nice for the farmers out there, unless you're in Texas or the Southern Plains or something like that. But this is really nice for the primary corn belt to kind of give you an idea of whether that corn acreage base can get bigger because of lower fertilizer prices, lower fuel prices, and what the weather looks like. And so these are the critical times other than that bean corn ratio. And you notice that the Midwest diesel price is getting back down towards the range that we had between 2011 and 2015 after spiking higher on the war and on the inflation as well. So the Federal Reserve policy is acting the biggest in the wheat market and the ag market, but it's also really following through into the energy markets. And that purple line there with the right underneath the price around $4.20 a gallon, that's your 100-week moving average. And I think once you go below that, it would be well suited to go ahead and start layering in some of your long needs, some of your purchases that you will need for spring and summertime. And some of the guys I've worked with when we were still up around 450, we did some spring needs and got up to May or 1st of June. end of June type time period. So I'm really on the hunt to go after the spring needs and on forward into the fall harvest if we can get that back below that 420 level and get especially closer to $4 a gallon. I think at that point, Jesse, that Ukrainian war and the emerging markets and what's happening in the global economy, because we've heard stories, I'm sure you've seen it, I'm sure the people listening have seen it. We've got more and more stories where the banks are getting more optimistic about the global economy in 2023 now. The OPEC people just raised their 2023 liquid fuel consumption number, not as much as Department of Energy, but at least it's going up. So again, I think as you get towards some of these major moving averages and some of these old highs back from the early mid 2000s, it may be time to go ahead and get something done.
Well, Mike, let's switch over to talk livestock. This cattle market, you and I have been talking about it. It's been interesting to watch. I know feedlot trade last week took quite some time to get going. And, this week things are quiet so far. But I think about this cattle market, weather, always an impact. We got some major winter storms potential on the horizon here the next week to 10 days. I wonder how that could affect this cattle market in feedlot country.
Yeah, this is a big deal because, I was really on getting ready to press the red button on hedging my end of Q1 and all of Q2 numbers because of the way the marketings look like they were backing up. I still think they're backing up, but those heavier, bigger cattle, if they go through a blizzard, it's only going to cause even more havoc on the supply side. So the European model, right before we went on air here, Jesse, the European model is bringing in a 10 to 12 inch snowstorm. It's sticking closer to the central part of the country like Nebraska and South Dakota, whereas the GFS moved everything up towards the Canadian-U.S. border. So the Dakotas and Montana and Minnesota getting still 20 inches of snow on the GFS. Well, be that as it may, whatever it is, it looks like it's big and it looks like both models are showing it. And so what this chart shows you is I think the trade's starting to price that in. We're almost at 165 in April and we've broken above the channel. And now we've gotten up against a trend line support. And so that daily chart that we're looking at right now looks like it's ready to go into a sell signal, but it could be staging kind of an exhaustion move up if this blizzard hits. The point being, we're at 160, 161 cash. If we see April cattle flash to 168, 169, I'm going to jump on it and get some puts bought.
Well, 164 right now is where April cattle are at, so only a few more dollars to go. I think that is very plausible. Feeder cattle market had an okay day on Wednesday. Probably one of the only markets that had positive action on the screen on the day Wednesday, Mike.
Yeah, and a lot of that due to that weaker corn market, that feeder corn ratio. One quick thing on feeders, though, if I went back and looked at some monthly charts today before talking to you, Jesse, and it looked like to me, while we're close to the 2015 levels and upwards of 2015 levels on fat cattle, we're a long way away from that with the feeders. And so feeders don't have nearly the premium that the fat cattle do, and that really surprised me because they typically have been running very close to one another when they make major highs and major lows.
Mike, let's move over to the hog market. Favorite thing to talk about, those hogs. Little bit of interesting trade, I think, in front of us the next couple of days or weeks with the April contract, assuming front month leadership at what, a $12, $13 premium to the cash index. What's your thoughts with April taking over as the lead month futures down here at Hogs?
Well, the featuring this week at the major grocery stores that I look at has really come on hard with the pork. You're talking about the best cuts of tenderloin at about $4.99 a pound, and you've got 93% ground beef at $5.99, $6.99 a pound. Chuck roasts around $5.99 a pound as well. So you're beating everything out there, even some of the higher chicken quality parts. As far as pork. So I think we found our bottom in the cash. The cutout, I think that 80 number is a solid number, but I do think that April probably needs to work down closer to where the Fed went off and that cash index. And so I could see the hogs going sideways to lower here for the next couple weeks and try and build up some steam for another move up. The monthly chart's trying to give a buy signal, but that we're still quite a couple weeks away from the end of February.
Well, Mike, great thoughts and analysis as always. Before we run out of time and wrap it up, floor is yours. Anything else you want to mention or reiterate for us today?
Yeah, just a lot of stuff coming out right now and trying to keep track of it and trying to put it into little bins as far as what's important, what's not important, what's short term, what's medium term. And I think the highlight of today's show and the analysis, if you get a trial, is did we do anything to hurt the long-term trend? And those wedges, those pennants, those triangles, we really haven't, even though the dollar's going up and the emerging markets look shaky. So that's where we're at. I'd get a trial. I'd try it out as far as our analysis and see if you can't pick up some more medium-term analysis that maybe settles you down when you get these news flashes that kind of drive you crazy.
Well, Mike, if folks want to get a trial, want more information, how can they do that?
Globalcomresearch.com is the best place to go, Jesse, for a trial. Call me toll free at 866-471-2588 if you need to know more or have a specific question.
Well, we appreciate the time and analysis as always. Mike Zuzolo, Global Commodity Analytics. Have a great week, sir. We'll talk to you next week.
Thanks for having me, Jesse.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.